two ways that the government can control the economy, which are fiscal policy and monetary policy. Monetary policy is controlled by the central bank, interest, and reserves, while fiscal policy is controlled by the government taxes. In today's video, we're going to talk about fiscal policy. Fiscal policy is the government's powerful tool to steer the economy. It impacts every business in profound ways. But what is it, and how does it influence your businesses? Fiscal policy refers to the use of government spending and taxation to influence the economic activity. When governments increase spending or lower taxes, it stimulates the demand, opening new opportunities for business to grow. On the other hand, by reducing the spending or higher taxes, can tighten budgets, slow down growth, and demand strategic adaptations. Understanding fiscal policy is critical. It helps businesses to anticipate changes, seize opportunity, and navigate challenges effectively. Fiscal policy shapes our business environment. Are you ready to leverage it to your advantage?
And today I'm going to give a quick but clear explanation on fiscal policy, what it is, how it works, and why it matter for our economy. It also gives you a real-world example to help bring it to life. So let's start with the basic. Fiscal policy is the way the government uses its spending and taxation decision to influence a country's economy. It's a powerful tool to manage things like economic growth, unemployment, and inflation. There are two main types of fiscal policy, expansionary and contractionary. Expansionary fiscal policy is used when the economy is slowing down or in a recession. In this case, the government may increase spending, cut tax, or both. The goal is to put more money into people's hands, encourage them to spend, and stimulate economic growth. On the other hand, contractionary fiscal policy is used when the economy is growing too fast, which might lead to high inflation. In this case, the government may reduce spending or raising tax to cool things down a bit. Now, why is fiscal policy is important? Because it helps smooth out the up and down in the economy. Without it, a recession could be much more deeper and recover slowly. It's also allowed the government to invest in important areas like infrastructure, education, and healthcare, which support long-term economic growth. Let me give you a real-life example to show how fiscal policy works. During the COVID-19 in 2020, many countries faced a sudden economic slowdown. Business closed, unemployment, and millions of people lost income. In response, the U.S. government introduced a major expansionary fiscal policy that includes sending direct payment to most Americans, expanding unemployment benefit, and offering financial support to small businesses. The goal was to prevent a total collapse of consumer spending and to keep the economy moving. This was a textbook case of using fiscal policy to deal with a crisis. Of course, fiscal policy has its challenge. If overused, it can lead to a large government debt. If poorly timed, it can be inflation. So it has to be carefully planned and adjusted based on the current economic situation. To summarize, fiscal policy is about government spending and taxation decision. It helps manage economy cycle and support long-term growth. A good example is the 2020 COVID program, which were designed to help the economy recover from a massive shock. That's a quick overview of fiscal policy, and that's it for my part. Thank you.
And that's a wrap on fiscal policy and its impacts on businesses. Let's quickly recap the key takeaways. Fiscal policy, through government spending and taxation, directly shapes the economic environment businesses operate in. When the government increases spending or cut taxes, it can boost demand, helping businesses grow, like we saw with the stimulus packages during economic downturns. On the flip side, higher taxes or less spending can tighten the economy, pushing companies to adapt. So, why does this matter in corporate finance? Fiscal policy influences a company's cash flow, investment decisions, and strategic planning. For example, tax incentive can free up capital for expansion, while budget cuts might force cost-saving moves. Understanding fiscal policy helps financial managers anticipate changes, make informed decisions, and keep their businesses competitive. In short, fiscal policy isn't just a government tool, it's a game changer for businesses. By understanding its effects, companies can navigate economic changes and thrive. Thanks for watching. We hope this clears things up.